All right, so let's set the scene here, right? You're waking up in the morning, your alarm goes off, you grab your phone, and before you even get out of bed, you're looking at what's taking place in the markets. Before you even poured your coffee, you're starting to notice a lot of stocks that are just screaming up higher. Unfortunately, you don't obviously have any of those. And you also notice some of the stocks that are going down a lot, and those are the ones that you are holding, unfortunately. And then you start to see a bunch of stuff and news going off in social media. You look at your chats that you're a part of, and people are posting different setups and screenshots, and you come to the ultimate conclusion, and this question that's bubbling up in your head is, what do I got to do right now to make the most of money in the quickest amount of time and have a good trading session? And well, if that is you, you are basically putting yourself in a position to make the worst decisions when it comes to trading ever. Now, if this is you and you do it or been doing it for a long period of time, but you still have this feeling that you're right around the corner from big gains and consistent probability, I'm here to tell you that you're not just around a corner that you're driving. You are driving in a circle, and it is an endless cycle if you don't break it. Now, these beliefs aren't coming from logic. They're coming from your brain working against you. And it's really time to start to understand what's going on internally to reframe and reapproach your way of trading. Our brains, they're not built to be successful traders. They're built for survival. And the markets take advantage of that, greatly so. There's something called prospect theory that in 1979, two behavioral economists talked about this. And what it tells us is that the perceived risk, as far as investors go, the perceived risk of losing is 2 times more powerful than perceived gains. So we put more weight mentally on losses. And to understand this from a perspective of a trader is critically important because it'll help us understand why it is that we do what we do and why they say some 95% of traders fail. For example, imagine you taking a trade and the stock starts to go in your favor. Well, looking through prospect theory, if it starts going in your favor, you start to hold more weight on the potential of a loss. So as it goes further and further in your favor, mentally, we just don't want that to turn into a loss. So what happens is we typically try to take the trade off or redeem those profits before having to deal with the weight of a loss. Now, on the other side of that, if we take a trade and it starts to go against us right away, the emotional impact that gives us and the weight of realizing that loss outweighs critical thinking. And what we tend to do is either one, add to that and double down on it. And we get into a cycle where if it keeps going against us, we're all of a sudden saying, hey, if this trade were to come back to just break even at this point, I'll never put myself in this situation again. Now, we could also layer on top of that some other cognitive biases as well, like overconfidence bias, where a few small wins all of a sudden gives us the feeling of invincibility in the markets, that we just cracked some sort of a code and we know exactly what we're doing. And this opens up the opportunity for risk to really take advantage of us. There's another one called myopic loss inversion. And what this is doing and telling us is that the more we focus in on every tick that the market moves, the more that every single move feels like life or death situation. And we end up making rash decisions that are different from what our original plan actually was. So prospect theory, overconfidence bias, myopic loss inversion, these cognitive biases can keep us in a negative cycle if we're not aware of what they actually are. Now, here's where it gets very tricky. The very part of your brain that's designed to help you be successful at trading, the logic center of your brain, the prefrontal cortex, can get hijacked while risk increases. So if you think about it, if you're not trading, but yet you're spending your time thinking about how you're going to approach the markets, whether you're back testing, whether you're looking at new indicators, reading price action in a different way, planning your next day, planning the week, planning the month, whatever the case is, you're thinking very clearly about it. And things make sense then when you're thinking about position sizing and strategies, etc. But once you actually are in the heat of trading, when stress levels can elevate, when risk increases, what happens to your planning and your strategy, or what you're prone to letting in, is the amygdala, the part of the brain, the fear center, starts to release chemicals. And these stress chemicals, Amy Arntzen, which was a neuroscientist out of Yale, discovered that these chemicals can hijack your prefrontal cortex. And this idea was popularized by another neuroscientist named Daniel, I don't remember his last name, and it was called the amygdala hijack, where it's, in theory, hijacking your ability to think logically about a situation, and you start reacting more emotionally. That's why when you know the plan of trading and you know your setups and you know what you're looking for, sometimes even when you do that, all of a sudden things could turn against you very quickly. You wait, you prepared, and as soon as money enters in and it starts going against you, you start thinking differently. Your brain and chemistry is completely changing. And that's because you're not quite in control anymore. If you're not aware of this, you are being hijacked. And the bigger, deeper truth that I want you to take away from all of this is that your brain wants you to lose because it's evolved to avoid pain, to chase comfort, and react to stress, which is the exact opposite of what professional traders and successful traders do. So there is an allure to big wins, right? You want big, fast, quick wins, and you can share it on social media, be excited about it. And here's the problem is these big wins that we chase, they're not just creating volatility in our portfolios, they're creating volatility in our emotions. And many of the times people will say that after a big win, I'm going to take it seriously. At this point, I'm not going to do that again. I'm going to take it seriously. But there is research on the subject. There's something in 1990 written called the house money effect. And this tells us actually there's a higher probability that we actually will end up taking more risk at some point because of what we priorly did, or a big win, because we tend to feel like it's the house's profits. Now, there's been neuroscience that actually back this up as well. And this cycle of bigger win, bigger risk, painful loss, and then chase once again, it doesn't just drain your account, it does wire your brain, and it creates not only a roller coaster of emotions, but what you'll tend to notice is more volatility in your P&L curve. You'll see big swings up, followed by big swings down, big swings up, followed by big swings down. And it's not until you start to break those habits and stop chasing the one and done sort of mentality, you'll start to notice slower movements of consistency and process, and how it outweighs and there's less risk, and you get a much smoother P&L curve like the one that I'm sharing right here. The traders that are going to last and thrive are the ones that are able to break this negative feedback loop that our brains put us in. And they do this by building a process and having a discipline to stay within that process. Paul Tudor Jones has preached the same thing for decades. You got to focus on the things you can control. And what he says here is focus on protecting capital, not chasing returns. Now, there's 4 things that we have complete control of in these markets. It's what are we buying, when are we buying it, and how much of it, and then when we sell it. If we get good at focusing in on the things that we can control, chances are we build process around that and discipline, you're going to be a much more successful trader and avoid any of those negative cognitive biases that can really pull you back into a negative feedback loop. Process, discipline, consistency, these things compound over time. And if you keep on repeating it, with discipline, it's going to outpace anybody who gambles and tries to double down on losing or is trying to take out those big wins. Chasing these big wins, big gains, and trying to speed up this process without actually having a process. It's exciting, but unfortunately the real cost of that is blowing accounts, anxiety, anxiousness, and years of lost progress. So the truth of all of this is people want a shortcut, and the shortcut is simple. There is no shortcut. It requires you to build on process, discipline, time, consistency, and focusing in on the things that you can control. I'll end with this to maybe keep in your head, and that is that fast money will fade and process will compound. Hope today's video helped out. See you later.